While the global financial system was undergoing liquidations at the start of last month, something weird had developed at the Federal Reserve's discount window. Banks all of a sudden decided they were going to start repaying loans that they'd previously taken out from the Fed. This despite the fact that Federal Reserve officials have been trying to encourage banks to borrow even more from the discount window, which is also known as primary credit. The timing raises a few highly relevant questions, especially now that we're in September. Why choose the early August chaos to start borrowing less from the Fed? What might that say about how conditions are being perceived on this side of the event when everything is supposed to be fully back to normal? At least back to normal is how it looks from the stock market. We have a number of other concerning indications to go along with these questions. U.S. primary dealer banks continue to hold massive amounts of U.S. Treasury bonds and notes in their inventories, which is a clear sign of anticipating more trouble. Along similar lines, overseas reserve managers have piled up another record high in their dollar liquidity buffer with the Federal Reserve too. In the marketplace, U.S. Treasury yields refused to September. They're stubbornly lower just off their early August lows. The curve continues to bull steepen and even broadening out more. The 2-year 10-year spread uninverted for the first time last week and looks like it's following the usual pattern before breaking out further along the same lines. Commodities, they're cracking all over the place. I mentioned gasoline in yesterday's video. Well, it's down another dime today and under $2 a gallon, at least in wholesale markets, and very close to a 3-year low. Oil prices are off sharply with fading geopolitical risk, leaving the market to consider very ugly demand expectations and not just those related to China. There is a total risk off outside of equities, obviously, a high degree of safety and risk aversion that also just might answer the questions I raised. Might U.S. banks be repaying primary credit out of an abundance of caution? And if so, what might that say about the state of conditions on this side of those liquidations? Well, let's start with the Treasury market. The Treasury market's answer is not a good one. Even this morning, Treasury yields continue to be lower, biased lower, rather than moving higher as we would expect from the September effect. The 10-year U.S. Treasury as of this morning is at 3.83%. It's still only a few basis points off of its early August low. Despite the fact that we're in September and rates are supposed to be biased higher, they're actually biased lower. The 2-year Treasury at 3.85 is still just a couple basis points inverted. It had inverted for the first time in a closing price last week, and this is just the usual pattern. Like inversion, uninversion, it kind of goes a little bit at a time. It happens and then it doesn't stick and the market goes back to inversion. Then it uninverts and then reinverts again until finally making that big move as other parts of the curve like the 5-year, 10-year spread had done previously. So the Treasury curve continues to bull steepen and send signals that it's going to continue to be more decisive about the bull steepening, which is not a good sign. That is a sign of risk aversion. As I mentioned, commodity prices, WTI is down big today on news that Libya is going to restart their production of oil and the deliveries of oils to the foreign market. But really, all of that geopolitics is a distraction from demand conditions. And as geopolitics begin to fade and whatever scare or risk that's perceived in the marketplace, the market's left with only demand considerations. And it's not just about China. You hear China most of all because China's the biggest buyer of oil, but it's also about the US, as I covered in yesterday's video. Expectations for demand in gasoline are really ugly and getting uglier by the moment. That's why gasoline prices are under $2 per gallon today. And WTI at $71, under $71. In fact, it's like $70.60 at the moment. That's the lowest price for crude oil in the U.S. since early January as well. So despite everything that's happened and everything that's supposed to happen, markets, whether they be financial markets or in this case commodity markets, and there's others like copper too, they're incredibly weak because the world did not move past early August. What happened in early August was many markets confronting for the first time the negative prospects that things are not going well in the economy, and therefore the financial system was a bit more fragile than people had been counting on. Certainly what they've been told from officials and politicians in the media and everyone else. Now, before we get to the numbers of the primary credit usage and what's happening there, We'll get a little bit of a background here, because ever since last year's banking crisis, officials have realized the discount window doesn't work. The discount window has never really worked, and it hasn't worked in a very long period of time. And the reason it doesn't work is simple. Everybody knows stigma. It's very widely believed that if you go to the discount window and somebody finds out you're borrowing from the Fed, you're out of business the next day, because that means you can't get funding in the private market. And in a marketplace where there's a lot of information asymmetry and opacity, if you're borrowing from the Fed, you can't get funding from the private market, there must be something wrong with you. You're not going to tell me what's wrong with you, so I'm not going to lend you anything. And so if you go to the discount window, the perception is that you're a troubled bank. And if you're a troubled bank, the rest of the marketplace is going to shut you down. So this stigma with the discount window has gone on for a very long period of time. That has not stopped people from using the discount window. You look into the 2008 crisis, for example. Banks were using the discount window quite heavily during 2008, which only proves it doesn't actually work as an effective liquidity tool, at least not on a systemic basis. But either way, Last year during the banking crisis, the real problem was collateral, but officials realized the discount window doesn't work in the way that they would like it to work. As a result, they have been trying to reform it, and part of that reform is to eliminate the stigma. And eliminating the stigma means a whole bunch of things. Federal Reserve Vice Chairman Michael Barr gave a speech back in Frankfurt, Germany in December last year, where he said, "Banks have previously said that they are afraid of receiving negative feedback from their supervisors in the event that their sole grounds for tapping the discount window is that it is most convenient or cheapest form of funding immediately available to them. In light of this, we at the Federal Reserve have been underlining the point to banks, supervisors, analysts, rating agencies, and other market observers and the public through numerous channels that using the discount window is not an action to be viewed negatively. Banks need to be ready and willing to use the discount window in good times and bad." So they're saying by using the discount window regularly, that will eliminate the stigma. We can't tell if you're a good bank or bad bank just because you're going to the Federal Reserve. You're just going to the Federal Reserve because it's a normal part of business. And this is something that not only the Fed officials are contemplating, it has become a political issue as well. And I don't mean partisan political issue, I mean government. Senator Mark Warner introduced a bill at the end of July, coincident timing here, as we'll see in just a moment. He introduced a bill at the end of July that would force large banks to use the discount window on a regular basis. Here's what Reuters reported at that time. On Friday, Democratic Senator Mark Warner of Virginia introduced legislation opens a new tab to overhaul the Fed's discount window, a long-running tool that provides fast collateralized loans to deposit-taking banks. The Fed is already working to make sure banks are ready and willing to use the discount window either in times of stress or if they simply face an unexpected liquidity shortfall. Banks have long shunned it, fearing that using it will send a signal of distress to their peers. And this idea of forcing banks to use the discount window regularly is not something that he came up with. It's something that basically federal officials have been contemplating for quite a period of time. In fact, there was a study released by the Federal Reserve Bank of New York, or at least it was an exercise and an experiment in econometrics from the Federal Reserve Bank of New York just a couple months before this, back in May, which they realized how difficult the stigma issue actually is. Reading from that study, the abstract. The discount window, however, has not been effective because its usage is stigmatized. In this paper, we study experimentally how such stigma can be cured. We find that once a discount window facility is stigmatized, removing stigma is very difficult. This result is consistent with the Federal Reserve's experiences, which have been unsuccessful at removing the stigma associated with its discount window. And I raise this paper for a couple of reasons, not just their conclusion, but they do design some pretty compelling and interesting econometric experiments, which, econometrics are questionable. Some interesting econometric experiments that they put together. And this is their conclusion. Setting the cost of the discount window to zero, for example, an extreme scenario under which discount window borrowing is not only the equilibrium, but is also a dominant strategy, also fails to cure stigma fully. An econometric analysis reveals that once the discount window becomes stigmatized, inertia sets in and subjects' behavior becomes less responsive to the feedback they receive. These results, combined with the results in a prior paper, that's A&H, suggest that requiring random borrowing can be considered a preventative but not a curative intervention to treat discount window stigma. So they tested the idea of forcing banks to regularly use the discount window, and it wasn't completely effective either. But it's at least one tool that policymakers as well as politicians can use to try to move in that direction, which is why Senator Warner was introducing that bill in Congress. And it's why the Federal Reserve itself has been encouraging banks to use the discount window on a regular basis. When the Federal Reserve shut down the BTFP, or the Bank Term Funding Program that had developed because the discount window wasn't effective during the March 2023 banking crisis, when they shut down the BTFP, the expectation was that some banks that were using the BTFP for funding would roll over to primary credit, the discount window, because it was there from the Fed. And that did happen on a very limited basis. So the Fed shut down the BTFP on March 11th after eliminating the arbitrage back in January. And what we see is that the discount window use rises at least a week later. So for the week of March 20th, the Fed shows that the discount window balance was $2.17 billion. The week after that, March 27th, it rises to $6.09 billion. So banks are rolling off BTFP and rolling into the Fed's discount window. But it doesn't really go all that much higher, just kind of back and forth consistently around $6.5 to $7 billion up until this final week in July, which is when Senator Warner introduced this bill in Congress. That's not what really mattered. It's just that's coincident timing. But it is interesting timing nonetheless. The final week in July, the discount window balance was $6.61 billion, which is, again, perfectly consistent with the prior behavior over the couple months leading up to then. But then we had the fireworks, we had the liquidations, we had the chaos in the marketplace. Banks begin repaying their discount window loans. For the week of August 7th, the balance falls to $4.4 billion, which is the lowest since the switchover from the BTFP. Then the week after that, the middle of August, it falls even further down to $2.31 billion. And then the week after that, which is the final week in August, the latest data that we have available, it dropped all the way to $1.77 billion, which is the lowest for the discount window, primary credit, since June of 2022. And so we got to ask, what the hell's going on here? The global financial system experiences liquidations and volatility, and banks take that moment, timed exactly to that moment, to say, we're going to start repaying our loans from the Federal Reserve. Now, there are a couple of different possibilities, and one of them is actually interest rates and interest rate differentials. It's very possible that with short-term interest rates lowering, anticipating Federal Reserve rate cuts in September, that maybe it made it economical for whoever was using the discount window up until the end of July to switch over to private market funding. Now, while that's possible and it sounds plausible, it doesn't necessarily match the data that we had. In fact, it really doesn't match it well at all. Now, keep in mind that the discount window rate, which is set by the Federal Reserve, the FOMC policy, is currently 5.5%, and it's set above market rates on purpose. It's supposed to be a penalty rate. Now, the penalty has been reduced over time because they want to encourage discount window usage, but still 5.5% is right at the top of the federal funds range, and money market rates are around 5.3, 5.35, somewhere in there. So using the discount window, you're already paying a more expensive rate than the published rates that we get from these money markets. We look at, say, for example, 3-month term SOFR as a possible alternative to the discount window, because the discount window is potentially, you can borrow from the discount window up to 90 days. So maybe 3-month term SOFR, those rates go down and you find it more it's cheaper to borrow from the private market at 3-month SOFR than it is at the 5.5% discount window rate. But what we find is that 3-month SOFR rates have been moving lower since June. June 20th, 3-month SOFR was at 5.35%, and by August 1st, it had already dropped about 11 basis points to 5.24%. There was no change in the discount window usage. So that lowering rate of SOFR didn't trigger a repayment in discount window borrowing. But then the 3-month SOFR rate falls all the way to 5.06% that first week in August, and it moved back up in the middle of August before falling again to around 5% where it is currently. It just doesn't line up here. And it lines up even less when you look at 1-month SOFR, which is 5.35% the week leading up to early August. It only dropped to around 5.29% that first week in August, and it was back up to 5.34 by the middle of August. So 1 month SOFR doesn't match what we're seeing in the discount window use at all. It really doesn't seem to be interest rates that explain what happened here. And the other alternative explanation is, well, the Federal Reserve engages in, updates its collateral list, its haircuts, and its margin requirements for borrowing at the discount window because primary credit is collateralized. It's sort of like repo, and it's intended to be like repo. So you have to post collateral, and the Fed decides a whole bunch. There's a whole table on what their margins are and their haircuts are for various asset classes, and they updated that for the to be effective actually as of today. And most of those haircut and margin updates were actually favorable to anyone using the discount window, so that doesn't seem to be a factor in what's driving bank decisions here either. So what we're really left with is potential stigma, which, as everybody says, as all the studies said, as politicians understand, as Federal Reserve officials understand, there is that stigma. So there's a possibility that banks who are borrowing from the discount window, when the feces and the fan blades got together earlier this month, or earlier last month in early August, they decided it just wasn't worth the risk. Even though the Fed is trying desperately to eliminate the stigma of the discount window, they didn't want to stick around and find out because maybe just out of a small chance, with the monetary system experiencing those difficulties and liquidations, it just wasn't worth paying 5.5%. It wasn't worth going to the Fed, even if you didn't really have a private market alternative, because the danger being that same stigma that's still with the discount window all of these years later, even despite all of the efforts to eliminate it. So what does that say about potentially what banks are thinking about the condition in the monetary system, the banking system in the United States post early August? And as I mentioned in the beginning, and I've gone over this recently, we've seen other indications that suggest the monetary system is not viewing everything this side of early August with the same type of positivity and optimism that gets priced in the stock market. In fact, quite the opposite. One of those is the foreign repo pool. And the foreign repo pool is a liquidity buffer that foreign reserve managers use. They hold it at the Federal Reserve Bank of New York. And this foreign repo pool got to a record high, at least a record up to that point, in late July, which already signaled that things were not moving in the right direction. It got up to $406.8 billion the week of July 24th. It moved back the final week in July and then kept moving lower through the early part of August and then started to rebound again, so that by the end of August, the foreign repo pool balance was up to $413.1 billion, which is a new record high. And this corresponds to the balance in the repo pool moving back and forth corresponds very closely with other monetary indications in Eurodollar cycle numbers that we continue to follow. And so this is another one that when reserve managers are holding a higher dollar liquidity buffer with the Fed in New York, suggesting their perceptions of the monetary system and potential illiquidity and problems goes along with holding a higher liquidity buffer. You only do that as a defensive measure. Same thing with U.S. primary dealers holding U.S. Treasury notes and bonds. This is more relating to collateral conditions, not just in the U.S., but more broadly. But when U.S. primary dealers hold more Treasury notes and bonds, it's anticipating either needing the collateral for their own purposes or stocking up collateral and inventory, expecting that other people are going to need it and will be desperate enough to pay more to rent it from you. So there's a profit opportunity because of a collateral shortage in the marketplace. That one got up to a near record high of $218.3 billion the final week in July. Then it surged to a record high of $236.7 billion, basically confirming the collateral nature of what happened earlier in August. So $236.7 billion on the week of August 7th, which is a record high. And probably it was dealers taking advantage of the opportunity, as well as the fact that they could borrow cash relatively cheaply, given the fact that they're good standing banks and a lot of people were, flight to safety and liquidity. So cash was available for them on the cheap, and they could relend the collateral that they put into inventory at higher rates. So everything made sense about early August. So we've got a whole bunch of indications, starting with the marketplace. Treasury market, the curve continues to bull steepen, which is not a good sign there. Safety and liquidity and high demand and all that goes along with it. Commodity prices that are down very sharply. Commodities telling us that there's not really a whole lot good going on across the global economy. Not just China, but also the United States. That's where gasoline prices really stand out here. So we got those going on. Risky stuff, U.S. recession, all of that. Then we've got foreign reserve managers, I just mentioned, holding a record high liquidity buffer in the repo pool. That's not a good sign. U.S. Treasuries, primary dealers are holding more and more of notes and bonds in their inventories, which is not a good sign as far as collateral. And behind all of this, we've got what banks have done with the Federal Reserve's primary credit. They've gotten out of primary credit for reasons that are not easily identified. It could potentially be because short-term interest rates, especially at term, are starting to go lower, anticipating lower interest rates as the Fed cuts and everything else that goes along with them. But that doesn't line up with the behavior that was seen at the discount window. The interest rate explanation doesn't seem to explain what we're really observing. Instead, I think it goes back to stigma. Banks saw what was going on in the marketplace early August, the timing here is very compelling, and decided it just wasn't worth it. Why bother taking the chance of borrowing at 5.5% from the discount window when, if everything continues to go in the same direction, it might actually end up being a much bigger deal. So repay those loans, even if those are the loans that you're getting at the margin, and just ride out the next little while. But as the discount window use goes lower and lower, it suggests that the next little while and writing it out is going on longer and taking longer than maybe these banks were anticipating. When you look at it this way, it's yet another signal that things are indeed different on the other side of early August. It wasn't just a modest recession scare that came out of nowhere and then just went away, dissipated as the stock market would have you believe and how it's pricing. Instead, we're seeing all these indications that U.S. recession risk really does change a whole lot of fundamental properties all across the system, in the economy, in the financial markets, even in money and banking. I went into a little more detail on the foreign repo pool as well as dealer holdings of U.S. Treasuries in a previous video, and that's the one I've got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.